So today we're going to talk about funding. To make this concept extremely easy to understand, imagine starting a company called Fintrax, and in the beginning you will have 100% of the ownership of the company. But you don't have personal capital to invest. That means you cannot bootstrap your company. You will have to raise external capital in order to build and grow your product. So you go out seeking investment from external investors, which is called seeking funding. Now, a very important question to ask here is, why will that particular investor give you money? He needs ownership in your company. So what the investors essentially saying is, I will give you 1 crore rupees, and for that 1 crore I need 30% of your company. Now you are left with 70 and that investor has 30. So now let's take a case where a person has both personal capital and he can also bring funding to his company. Then which side should he pick? Bootstrapping, that means investing your personal capital, uses profits to grow and reinvest back into your business. Whereas in the funding case, raise external capital to grow fast, take investors' money to invest aggressively and capture a larger market share. All kinds of people fund into startup, where it starts from angel investors who give you small capital, then goes on to venture capitalists who invest larger checks, and then it moves on to private equity who put much larger check from which you can raise really large amounts of money. So starting with angel investors, they are wealthy individuals who invest very early. They primarily bet on the founder and the founder's vision. Then comes VCs, venture capitalists. These are professional firms who invest large amounts to fuel rapid growth. Then comes private equity, late stage investors who put really large checks into mature startups. Then IPO. Now, a very important thing to understand here is, funding rounds are ladders for the investors to make money. They want you to raise more rounds at increasingly higher valuations. This is great for growth, but also puts a lot of pressure on the founders to perform and hit milestones faster. So after angel round, all the series that comes is called as venture capital, where the professional firms are investing after looking at the growth of the startup. After the product is built and initial users are onboarded, now you would need higher amounts of money in order to spend aggressively on marketing and advertisements and onboard as many users as you can. So then you will go on to raising venture capital from VCs. So now you reach out to many VCs, and from that, one VC is really interested in your idea, your vision and your product. He looks at everything, does his due diligence, and comes to a conclusion that okay, so he's giving 5 crore rupees for 20% of the equity. Now you as the founder have only 50% of the ownership left. 30% you gave it to the angel and 20% you gave it to the VC. Now you have 50% of the ownership left. Now again you got 5 crore as capital, and now you can invest this money into marketing and onboard as many users as you want, and also improve your app or technology. You were able to put that 5 crores in your product, hiring, marketing, and now from 5,000 users, using that 5 crore venture capital, you were able to onboard 5 lakh users into the platform in over a span of 2 years. Now your 5 crores is again over, and after you get 5 lakh users, you start to monetize your platform and start to make revenues from the user. But here is the catch: 100% ownership of a 1 crore business equals 1 crore rupees. But owning as low as 10% of a 1,000 crore company can be 100 crores. So even if your ownership is less, the value of that ownership can be more. That entirely depends on the valuation and how much value you create with that company. Now let's talk deeply about what do these investors look at while investing in each stage of the startup. The angel just talks to the founder, gets to know his vibe, sees founder's past experience, and it takes solely his bet on the founder. And most of these angels are startup founders who are very successful by investing in a lot of startups. The founder and the founder's vision of what he wants to build. Then comes VC. What do VCs look at? They look at scalable business models. Like more the money you put, more the business grows. But for that, VCs look at, does the entrepreneur have already built a scalable system or not? Can that be replicated or not? VCs see for large markets, strong team, unit economics. Only then they would invest. PE is a very mature stage of investing, where the startup is already mature, they have steady revenues, and they have clear profitability. But from where do these VCs get money? They get money from large financial institutions, pension funds, and various financial institutions in order to invest into startups and give their investors, who are called as limited partners, as greater return than they can get on any other asset class, the investment in startups. For VCs, the game is very simple. It is the game of power law. Even if you invest in 100 companies, they very well know that 95% of the startups would definitely fail. So this is the power law game that the VCs play. Now, why do VCs invest? Their only motive is to make money. They're putting 10 crores today so that after 5 crores, they can take out 100 crores from that same 10 10 crores. VCs invest aiming for exits. They will take out 1,000 crores of that 10 crores. It's in the game of 100 times or 1,000 times they'll make return on their money. Now, during all this chaos, founders face a lot of mental trade-offs. Dilution versus growth. You give up some ownership, but get the capital and resources to build a bigger business. Now, let's talk about valuations. There are many ways of valuing a company. There is a DCF way, discounting cash flow method. The easiest one of all these is revenue multiples. Let's say your company is making 10 crores annually. So depending on the industry or the sector of your startup, there is a valuation multiple that goes around in the market as a generic methodology. So let's say for tech companies that revenue multiple is 7, 8, sometimes it goes up to 10 times depending upon your growth. So let's say you're a tech company, you've made absolutely disruptive product, nobody is able to catch up to you, and your growth rate is very high. Then even with 10 crore as revenue, your company can be valued at a 10x multiple and your company's value would be 100 crores. Similar in case of FMCG, it's 3 to 4, beauty, it's 5. Revenue multiples differ as per the industry you are in and as per your growth rate. Early rounds are more about comparables and potential, but the later VCs round involve a lot of number crunching and financial metrics. So coming back to the Fintrax story, Fintrax finally wants to raise 200 crores and that amount is so big that can be only raised from the retail investors, that is the stock markets. Now they apply for IPO, initial public offering, where this startup, which is a private limited company, as it is selling its shares to the general normal retail public. But for that, they should show steady revenue, steady profit, steady growth, and then investors, if they believe in this company, only then will they invest so much in the company. And with that 200 crores, some of the part will go to paying the existing investors, the angel investor who believed in you when your app was just an idea. From that 200 crores, 100 crores would go to these investors, and the rest of the 100 crores would go to actually growing the company. Now your company would be listed on the stock market and anybody can trade your stocks. And now you have 5 to 10% of the company ownership left with you. So this is a typical journey of a startup from ideation to IPO. And in this process, I've explained you the entire process of how funding works, how VC system works, how a company actually grows. So this is the ultimate startup funding guide. Please hit the subscribe button for more such content. I'm here to guide your startup journey. Thanks for watching it till the very end.